Exercise 4-20 is a little bit more involved. We have an income statement and a balance sheet for Tiger Enterprises, and we're going to prepare the cash flow statement from that. So we got to do a little detective work in order to do that as we go through here. We're going to use the indirect method for the operating section. And remember that regardless of using the indirect for the operating section, the financing and investing section will be done doing the direct method. Okay, so we start with net income as always. And we see that net income is $900. And I suspect, okay, that's in thousands. So that would actually be 900,000, but we can just leave the zeros off. That doesn't matter on that. Now remember, the next thing that we're going to do is we're going to add back depreciation and amortization. So depreciation expense is 240,000, and I don't see any amortization expense listed on the income statement. So we add back the depreciation expense. And that was $240,000. $240,000. Okay, so that takes care of the depreciation. So now we're going to go down to our operating assets and liabilities. So cash we don't mess with because that's what we're trying to balance to. And we see that in 2020 we had 200,000. In 2021 we had 300,000. So now we know that our statement of cash flows, our net cash, overall statement of cash flow, increase in cash needs to be 100,000 in order to be correct. All right. Okay, so accounts receivable, we went from 830 to 750. So that's a decrease of $80,000. Which means we have an increase in cash. Remember, assets go the opposite direction. Inventory was 600 and is now 640. So we have a decrease in cash of 40,000 from a change in inventory. Okay, prepaid insurance also went from 20 to 30, so that's an increase, which means a decrease in cash of 30, and that's from prepaid insurance. Okay, equipment is going to be an investing activity, so we don't do that. So then we go down to our liabilities and shareholders' equity. We don't do that here. We're going to do that later. Accounts payable. So now we're on the liability side of the accounting equation, and so we go the same direction. So we had 360,000 in liabilities and accounts payable, and now we have 300,000. So we have a decrease of 60,000. And that's accounts payable. Okay, then we have accrued liabilities for general administrative expenses. That went down 100 from 400 to 300, so that will be an increase. Oops, sorry, same direction. So that will be a decrease of 100,000. Then we have the income taxes payable. It was 150, now it's 200, so that's an increase of 50. And so now we need to add those up to get our net cash flows from operating activities. Okay, so 900 plus 240 plus 80 minus 40 minus 30 minus 60 minus 100 plus 50. I get 1,040. So that would be 1,040,000 because we've knocked off 3 zeros. Next, we go to cash flows from investing activities. Now, you will always find the cash flows from investing activities in the assets section. So what we've got to do down here, we go down to the equipment. Remember we said that? And on December 31st of 2020, we had 1,800,000. And on December 31st, 2021, we had 2,100,000. So we increased by 300,000. That means we invested in equipment for 300,000. So we have a purchase of equipment for 300,000. Now, obviously, in a larger company, you're going to have some purchases and some sales of equipment as we go through. And when that happens, you're going to have to rely on the narrative. Now, we have nothing in a narrative to tell us that we disposed of so many assets. Lots of times you're going to have gains and losses when that happens too, when you dispose of various assets like that. So you're going to have something in the narrative to tell you what you disposed of. But we don't have any of that here, so we're just going to rely on the 300,000 on that one. And that is our only investing activity, because everything above that, the prepaid insurance and above, is a current asset. Equipment is the only long-term asset. And so that is our only possible cash flow from investing activity. So we purchased equipment, and so we've got net cash from investing is a minus 300,000. All right, then we go to the cash flows from financing activities. Okay, and we sit there and we go down. We go down on that. We've got the notes payable. We were at 600. Now we're at 800, so we have a change in notes payable of 200 on that. We're on the liability side, so it's the same direction. Since it went up, our cash went up. We also have the common stock. We were at 800 and now at 900, so we issued common stock. For 100. And then we're going to have to look at our retained earnings. Now, our retained earnings were at 540. So we're just go find a little scratch paper here. And what we're gonna do here is we're gonna do a miniature statement of changes in stockholders' equity, right? And so we have our beginning retained earnings, RE, and we see that is at 540. Okay, we know what net income was. That was 900. So that interim is 1440. Come down here, our ending retained earnings, we're told is 500. That means we had to have paid dividends of 940 in order to get to that retained earnings. So dividends paid be 940. So our total cash, and this is a negative, from financing, the 300 be 640. Negative. So 640 and 300 is 940. 1040 minus 940 is the 100. And that is our total increase in cash. And then we want to reconcile that and to do that, we'll sit there with our beginning cash is 200, increase in cash is 100, ending cash is 300, and that's what it is. And so we have done our cash flow statement correctly. All right, so that's a little more involved one. Obviously, probably a little bit too long to put on an exam per se, but we can do parts of that or some of the parts of that or do that. I tend to break these up into the different sections: investing, financing, and the operating section. All right, so we'll see you in the next chapter.